Can a small diplomatic thaw move entire markets? If U.S. Iran talks advance, your emerging markets playbook may need a quick rewrite. Here's the setup. Middle East stocks claimed as investors priced in a lower geopolitical risk premium. The prospect of dialogue eased fears around energy infrastructure and shipping lanes. In a region where oil drives cash flows, that shift can ripple through equities, credit, and currencies. Global funds took notice, hunting for stability while watching inflation, rates, and earnings guidance. Why does this matter for your portfolio? Risk premia shape equity multiples and borrowing costs. When the threat of disruption fades, valuations can expand and spreads can narrow. That supports capital formation and gives companies clearer visibility on budgets and profits. It also diversifies global portfolios at a time when rate paths remain fluid. Several signals stood out. Sentiment improved toward cyclicals and financials as the perceived chance of near-term escalation fell. Confidence grew that crude can move uninterrupted through the Strait of Hormuz, reducing tail risk hedging and volatility. Trading desks reported renewed attention from emerging market and frontier funds, with managers rethinking regional weights as diplomacy evolves. Softer risk premia can also blunt the inflation pass-through from energy shocks. That in turn influences expectations for central bank policy across importers and exporters. Sector dynamics followed the script. Banks benefit when funding markets stabilize and loan growth regains momentum. Petrochemicals and transportation gain from steadier input costs and more reliable shipping. Large liquid names often lead because they offer cleaner exposure with less single-name risk. As shipping and input cost uncertainty eases, analysts can tighten earnings ranges. Clearer numbers can support higher multiples. Credit markets feel it too. Sovereign and quasi-sovereign spreads can compress as geopolitical premia decline, especially where external buffers are strong. If steadier oil flows cool market-based inflation expectations, duration positioning may also shift. What can you do now? Stay selective. If you want exposure, focus on high-quality Gulf large caps in banking, petrochemicals, and logistics. Monitor headlines on U.S. Iran engagement and watch oil flow indicators. Track the Fed's rate path because yield differentials still steer capital. Use liquidity and risk controls since this market remains headline sensitive. Want the deeper dive in key charts? Read the full article at finlitica.com.